Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Friday, May 22nd. For those of you here in the U.S. and in some other countries around the world, it is the beginning of the last day before a three-day weekend. So we're seeing some skittish trading. Looked like they really tried to rally the market going into the open. I don't know who they are, but somebody seemed to just be buying futures, whether it's reflexively or in an effort to get others to come and play along. But that effort kind of failed. It doesn't surprise me because really the news from around the world is not particularly good. There was nothing great on the economic front. And I do think the developments in Hong Kong just add a layer of risk to world economics and world investing and the U.S.-China relationship, et cetera. And so that's not necessarily the reason for a rally, whether or not I think people were just more trying to exploit thin markets in advance of a holiday weekend. But because so many people are working from home, many fewer people are taking off for the long weekend. So I think the liquidity really was there to absorb what seemed to be sort of a strange rally. One thing I really want to allude to today, the main point, kind of buried the lead a little bit by not leading with this, but I read a very interesting article on CNBC.com yesterday, which I'll link to at the bottom of this video. And it's basically saying that someone did some research and found that a lot of the stimulus money, remember in the U.S. there was a $2.2 trillion stimulus package, over half of which went to individuals in the form of $1,200 stimulus checks, plus more for dependents, and et cetera. And that a lot of that money found its way into the stock market. I find that very concerning. I've really been wrestling with the fact that the stock markets have been going up without pretty much regard to valuation, without regard to underlying economics. It seemed as though there was this just source of new buying that was buying the same stocks, piling into them through narrow leadership, almost herd mentality. But I couldn't figure out where it was coming from. Now I get a sense that I do know where it's coming from. Now, I find this concerning on a couple of levels. First of all, equity markets have digested a huge flow of new money in a short period of time. Let's call it, it's not going to be the full $1 trillion+ that Americans received, because investing wasn't the first source of money, and that money went various places. But I'm going to say we digested billions that came into the stock market. I can't put a number on it. It's too hard. I just don't have that statistic. That money's now, for the most part, invested. They told people what they did with the money, and so if they invested it, that means it's invested. So that money is done. It's in. We always need a constant flow of new money to keep markets going. Usually that new money ideally comes from economic growth, earnings, et cetera. That's not here right now. So we would need an exogenous factor to continue that money flow. The Fed is increasing their balance sheet, but not at the pace we've seen. Yes, there's always the hope that there's a second round of stimulus. There's always the hope that there's a new round of equity, not a new round, but initial round of equity buying from the Fed. I don't see that the Fed is inclined to do that, and the stimulus bills seem to be stalled. So as of now, that's it. The money's in, and I don't know where the new money's coming from. Secondly, a lot of that money is going to have to flow out. Presumably, that money was sent to people to pay for necessities because many people are in economic distress. It just is the case. And so if you've invested that money, logically, I understand why people would be tempted to invest money in stocks rather than put it in a bank account that earns them nothing. Or in an interest-bearing account. Even the best interest-bearing accounts don't earn much. But there's a fundamental tenet of finance, and that is match your assets and your liabilities. If you've got short-term liabilities, you don't want to be locked up in long-term assets. Stocks are the ultimate long-term asset. Rent, mortgage, food are the ultimate short-term liabilities. That's a tremendous mismatch. So what you're doing is, if you put your rent money into the stock market, you've introduced a tremendous asset liability mismatch. That is very risky. And if you're buying on margin, well, unfortunately, you've increased the liabilities because now you owe money to the broker and you owe money to the bank who owns your mortgage or your landlord. Be careful with that kind of behavior if you're one of the people who've done such a thing. And third, many of the new investments seem to be coming from new investors. That's a really good thing overall for our industry. The article alludes to the fact that we and our competitors have seen a lot of new account growth over the past few months. That's a good thing overall, and it will be good for the industry as a whole, I believe. In the short term, new investors tend to make mistakes. We all do. I've made plenty. I don't know anybody who hasn't. There may be someone out there who never has, but everybody I know has made them, from the best to the worst. And so, if you have a herd of new investors who seem to be chasing some of the same speculative or well-known names, investing in a herd, and then they're going to start to need to spend some of that money on necessities, that could precipitate a little bit of a herd behavior out. And that's very risky when you have narrow leadership. These are the things that I'm concerned about. Let me be clear here. This by no means is meant to denigrate the idea of the stimulus, which I think was very smart government policy. The government needed to do something, and we hear Fed Chairman Powell advocating for more fiscal relief. This is also not meant to denigrate the recipients of that stimulus. There are a lot of people in a lot of need, and I'm glad they got money to pay for necessities. I'm also not going to question the idea of investing that money in a higher yielding asset, but I do question whether they have their risk tolerance measured properly. So my job here is, I've been a professional risk manager for decades now. I guess my bias is to look for risks that are hiding out there. That's how we've managed to stay out of a lot of trouble over a lot of years, both personally and professionally, and as a firm when we were managing a lot of our own money actively in the markets. And so my particular bias is to look for risks in the market. That's kept us out of trouble. It's kept me out of trouble. This is a risk I see. I really hope I'm wrong about this. It's a fairly high conviction that I have here that this is a big risk. I'd like to see us work our way out of this one. I really hope I'm wrong, because if I'm right, it means a lot of pain to a lot of people who really don't need it or shouldn't experience it necessarily. But for those of you who are watching this, please take this as something to keep in the back of your mind, and I remain wary until I get a sense that this is behind us. That was a lot. For those of you who are still here, have a great long weekend if you're in a country that's celebrating on Monday. Take care. Bye-bye.